Most changes that matter in an economy do not arrive loudly. They don't come with a sudden bang, but with a slow, almost imperceptible hum that gradually builds in the background. We are conditioned to look for the dramatic, the headline-grabbing events that signal a shift in our world. A stock market crash, a declaration of a recession, a sudden policy change that sends ripples through the news cycle. These are the loud noises that capture our attention. The truly fundamental transformations, however, rarely play out this way. They don't come with celebrations or viral hashtags. They don't trend on social media. They don't feel dramatic in the moment because their power isn't in their suddenness, but in their persistence. Think of the slow, decades-long process of containerization that quietly rewired global trade, or the gradual laying of fiber optic cables that set the stage for the digital world we now inhabit. These shifts happen quietly, accumulating in the background of our daily lives. They are the sum of 1,000 small innovations, 1,000,000 tiny adjustments in behavior, a gradual change in collective assumptions. And because they are so quiet, they are easy to miss. By the time most people notice them, the new reality has already solidified. The landscape has been redrawn, the rules of the game have been rewritten, and the opportunity to understand them early, to adapt, to invest, to prepare, has already passed. The quiet hum has become the new sound of the world. Right now, there is a quiet conversation happening in the world of economics, in boardrooms, and among long-term investors. It's a conversation that is taking place just beneath the surface of the daily news, away from the noise and the fury of the 24-hour cycle. This conversation is not about the next recession, though we spend endless hours trying to predict its arrival. It's not about a market crash, though we are constantly on guard against the next big fall. And it's not about the day-to-day of politics, which so often focuses on dividing the existing economic pie rather than finding ways to make it bigger. Those are cyclical concerns, the familiar ebb and flow of the economy. This is about something different, something structural. It's about something much more subtle. It's a hypothesis about the very engine of our economy, its fundamental capacity for growth. It's the idea that the U.S. economy may be able to grow faster, more sustainably, without triggering the problems that have historically come with growth. For decades, the accepted wisdom has been that if the economy grows too quickly, it inevitably overheats. Inflation accelerates, forcing the central bank to raise interest rates, which then chokes off the expansion. It's been seen as an unbreakable speed limit. But what if that speed limit is now higher than we think? That sounds abstract, like a theoretical debate for economists. But its implications are profound. It matters deeply for investors trying to value companies, for businesses planning future expansion, and for anyone allocating capital for the long term. It changes our assumptions about everything from interest rates and corporate profits to the sustainability of government debt and the returns we can expect on our savings. It redefines what is possible. To understand why this quiet conversation is so important and to grasp the evidence that is fueling it, from advancements in artificial intelligence to a renaissance in American manufacturing, we need to talk about a concept most people never hear about. It's a term that rarely makes the news, but it sits at the very heart of a country's prosperity. It's called potential growth. Potential growth is not how fast the economy is growing today. It's how fast the economy can grow sustainably over time. In other words, how fast the system can expand without overheating, without runaway inflation, and without forcing interest rates higher. For decades, economists believed there were strict limits to this. Grow too fast and inflation appears. Inflation forces central banks to raise rates. Higher rates slow everything down. This cycle has repeated again and again throughout history. But what if that limit is changing? What if the economy is becoming more efficient at growing? That is the question being quietly raised right now. When economists talk about potential growth increasing, they are not talking about optimism. They are talking about structure, productivity, efficiency, capital allocation, technology, organization, the invisible mechanics of how work gets done. When we think about economic growth, a simple image often comes to mind. More people working, longer hours, more factories, more effort. It's an intuitive idea that to get more out, you must put more in. For much of history, this was the primary engine of expansion. A growing population meant more hands for the fields and factories. Longer work weeks meant more goods produced. This is growth by brute force, by increasing the sheer volume of inputs. But this path has a fundamental limit. A day only has 24 hours. A population can only grow so fast. Eventually, you can't just add more. You hit a wall. The real story of modern prosperity, the kind that has dramatically lifted living standards over the last 2 centuries, isn't just about working harder. The truth is, sustained growth comes from working smarter. This isn't a platitude, it's the central mechanism of economic advancement. It represents a fundamental shift from a model of accumulation to a model of innovation. It's the difference between adding another horse to the cart and inventing the steam engine. One is a linear improvement, the other is a complete paradigm shift. So what does it mean to work smarter on a national scale? It means increasing productivity. In simple terms, it's about producing more value with the same amount of effort, or producing the same value with less effort. Think of a single baker. If she finds a new kneading technique that allows her to make 12 loaves of bread in the hour it used to take her to make 10, her productivity has increased by 20%. She hasn't worked longer or harder, she has worked smarter. Now, imagine that same principle of innovation applied across millions of workers and businesses in every sector of the economy. That is the engine of true, sustainable growth. That difference matters profoundly. When an economy grows simply by adding more labor and capital, it can often lead to overheating. Too much money chasing too few goods pushes prices up, creating inflation. But when growth is driven by productivity, the equation changes. The economy's potential to produce goods and services expands. It becomes more efficient. If productivity rises, the economy can grow without pushing prices higher. This is the holy grail for policymakers and investors alike. It means businesses can expand their operations and increase profits without squeezing their margins. It means wages can rise in real terms, reflecting the genuine increase in value that workers are creating, without triggering damaging inflation spirals. This creates a virtuous cycle. Higher wages fuel demand, and higher profits fuel investment in new, even more productive technologies. This is the ideal environment for long-term capital. It's a landscape where investment is not just about speculating on short-term price movements, but about allocating resources to companies and projects that are creating tangible, lasting value. It encourages a focus on the future, on research and development, on building more resilient and efficient systems for tomorrow. And this is precisely why investors, from individuals planning for retirement to the largest institutions, should pay close attention to the subtle shifts in productivity trends. It's easy to get distracted by the daily noise of market commentary, by geopolitical headlines and quarterly earnings beats or misses. But these are often just waves on the surface. The deeper, more powerful current is the economy's underlying potential for growth. Because markets don't just move on today's headlines. They are forward-looking mechanisms. They move on expectations about the future. The price of a stock or a bond today is a reflection of all the cash flows it is expected to generate for years or even decades to come. Therefore, a change in the long-term growth outlook is one of the most powerful forces that can reshape the investment landscape. If the future is one where growth can continue without the constant threat of inflation forcing central banks into aggressive tightening, then everything downstream changes. The calculus for every asset class is altered. Valuations for companies can be higher, as future earnings are more certain and discounted at a lower rate. Capital flows shift, moving away from short-term safe havens and toward long-term productive investments. Risk appetite increases, as the baseline for economic stability is lifted. And perhaps most importantly, time horizons lengthen. Investors can afford to be more patient, backing transformative but long-gestating technologies. But before we talk about markets, we need to understand what might actually be changing underneath the surface. Is there credible evidence that we are on the cusp of a new productivity boom? To answer that, we need to look beyond the headlines and dig into the foundational layers of the economy, the technology, the labor force, and the very ideas that will shape our future. The modern economy is not the same system it was 20 or 30 years ago. Supply chains are different. Information moves faster. Capital moves faster. Technology has altered how value is created. Businesses today can scale without scaling costs at the same rate. Software does not behave like factories. Automation does not behave like labor. Data does not behave like inventory. These shifts are easy to underestimate because they don't feel dramatic day to day. But over long periods of time, they change what is possible. This is why potential growth matters. It's not about predicting next quarter. It's about understanding the ceiling, and ceilings define long-term returns. For investors, this distinction is critical. Short-term growth is noisy. Long-term capacity is structural. When potential growth rises, it doesn't mean the economy will always grow faster. It means it can. And that optionality is powerful. When an economy's fundamental capacity for growth changes, it doesn't just alter the numbers on a spreadsheet. It rewires the very psychology of the system. It changes how policymakers respond to pressure. In a world perceived as fragile and slow-growing, every hint of a slowdown can trigger a maximalist response. Central banks and governments feel compelled to deploy overwhelming force, slashing interest rates, launching massive spending programs, out of a deep-seated fear that any small fire could become an uncontrollable blaze, leading to a prolonged and painful recession. The political calculus shifts towards immediate, visible intervention. But in an economy with a higher growth ceiling, that calculus is transformed. Policymakers gain breathing room. They can afford to be more patient, to distinguish between a minor cyclical correction and a genuine structural crisis. They can allow the economy to self-correct, trusting in its underlying resilience. Their focus can pivot from constant crisis management to fostering long-term health. Investing in infrastructure, education, and research, the very foundations of future productivity. This shift also fundamentally alters how businesses plan for the future. In a constrained environment, corporate strategy becomes defensive. Investment is cautious, often limited to essential maintenance and incremental efficiency gains. Hiring is tentative, with a preference for temporary or contract workers. The dominant fear is overextending into a downturn. But when the horizon of possibility expands, so does corporate ambition. Strategic planning shifts from survival to expansion. Companies become more willing to undertake bold, multi-year capital expenditure projects, building new factories, entering new markets, funding speculative research and development. Their time horizons lengthen because the potential reward for long-term vision outweighs the short-term risk of a cyclical dip. And, crucially, it changes how capital prices risk. In a low-growth world, risk aversion is the default setting. The equity risk premium, the extra return investors demand to hold stocks over safe government bonds, is elevated. Capital huddles in perceived safe havens, and funding for innovative but unproven ideas dries up. In a higher capacity environment, the appetite for calculated risk returns. Investors are more willing to look past short-term volatility and fund the next generation of transformative technologies. The cost of capital for innovators falls, creating a virtuous cycle where new ideas can more easily secure the funding needed to become new sources of growth. This difference in psychology is most apparent during periods of stress. In environments where growth is constrained, every expansion feels fragile, like a temporary reprieve before the next inevitable downturn. Every acceleration in economic activity invites fear. Fear of overheating, fear of inflation, fear that the central bank will be forced to slam on the brakes and end the party prematurely. A slowdown isn't just a dip, it feels like a potential abyss. The narrative is dominated by anxieties of a lost decade, of secular stagnation, where the economy is permanently stuck in a low-growth trap. Recoveries are slow and grinding, often described as U-shaped or even L-shaped, leaving deep and lasting scars on the labor market and public confidence. In environments where growth capacity is higher, the entire emotional landscape shifts. Expansion feels more stable, more durable, rooted in genuine productivity gains rather than temporary stimulus. Corrections feel less existential. A downturn is viewed not as a potential catastrophe, but as a necessary and even healthy process, a way to wash out excesses, reallocate capital from less productive to more productive uses, and set the stage for the next phase of growth. These downturns are often sharper but shorter, the classic V-shaped recovery, where the economy's inherent dynamism allows it to rebound quickly. The fear of a permanent slump recedes, replaced by a confidence in the system's long-term trajectory. This doesn't eliminate cycles. The rhythm of expansion and contraction is inherent to a market economy, but it changes their texture. It changes their duration, their depth, and most importantly, how they are perceived by the people living through them. And this is where many investors get confused. They are conditioned by the recent past, their mental models shaped by the environment they know. They expect clarity. They want certainty. They look for obvious signals. They scan the headlines for a definitive announcement, a single data point, a clear statement from a central banker that declares the regime has changed. They want a simple, unambiguous story to guide their decisions. But the most important economic shifts, the deep structural transformations that redefine what is possible, rarely announce themselves clearly. They don't arrive with a press release. They begin quietly, in the background, often obscured by the noise of cyclical data. They reveal themselves slowly, and only in retrospect does the pattern become obvious. They reveal themselves through the data, but not in the headline numbers that dominate the news. The clues are buried deeper, in subtle upticks in total factor productivity, a measure of innovation, in shifts in new business formation, in the changing composition of capital investment. They reveal themselves through behavior, when businesses start making those long-term bets again, when labor markets become more dynamic, with workers moving more freely to better jobs. And they reveal themselves through changes in how systems respond to stress, when the economy absorbs a shock that would have previously sent it into a tailspin, and instead, it bends but does not break. The idea that the economy may be capable of higher sustainable growth does not mean there will be no downturns. It is not a promise of a perpetual bull market or an end to volatility. It means downturns may behave differently, driven more by inventory cycles than by systemic financial crises. Recoveries may look different, characterized by rapid reallocation of resources rather than a slow, painful grind. And most profoundly, the balance between growth and inflation may shift. For decades, the prevailing wisdom was that strong growth would inevitably lead to runaway inflation, forcing central banks to intervene. But a productivity-driven expansion is different. It is, by its nature, disinflationary. When companies can produce more goods and services with the same or fewer inputs, they can meet rising demand without raising prices. This allows for a high-pressure, high-output economy to run hotter for longer without triggering the inflationary alarms of the past. And that is a structural change. It is not a temporary fluctuation. It is a fundamental alteration in the economy's underlying architecture. This pattern is not new. Throughout history, the great secular bull markets, the long periods of strong returns that created generational wealth, have been associated with periods where productivity improved faster than anyone expected. These were not born from blind optimism, but from tangible, systemic change. They happened not because people were optimistic, but because systems became more efficient. The cost of energy plummeted. The speed of communication accelerated. The friction of distance was reduced. These were not psychological phenomena. They were engineering and organizational triumphs. Think of the Industrial Revolution, when the steam engine and mechanization redefined the limits of production. Or the post-war expansion, fueled by mass production, electrification, and the build-out of global infrastructure. Or the digital transformation, when the microprocessor and the internet collapsed the cost of information and created entire new industries from scratch. Each era was initially misunderstood. Each was doubted. In the late 1980s, the Nobel laureate economist Robert Solow famously quipped, "You can see the computer age everywhere, but in the productivity statistics." The impact was real, but it took time for businesses to reorganize their processes to fully exploit the new technology. The initial investments didn't immediately translate into measurable output gains, leading many to dismiss the hype. But eventually, each of these transformations asserted itself in the data and, more importantly, reshaped long-term outcomes for economies and for investors. The question now is not whether history repeats exactly. It never does. Each era has its own unique drivers, its own challenges, and its own character. The question is whether we are once again underestimating how much efficiency can change what is possible. Whether it's through artificial intelligence optimizing supply chains, new energy technologies lowering the cost of power, or biotechnologies extending human health span, the potential for systemic efficiency gains is profound. The question is whether we are too focused on the cyclical noise to see the structural signal, and whether capital is positioned for that possibility. Is the prevailing investment posture still calibrated for a world of scarcity and low growth, or is it adapting to a potential world of greater abundance and dynamism? Because when the economic ceiling moves, capital that understands it early behaves very differently from capital that reacts late. Early capital is proactive. It invests during periods of uncertainty, accumulating assets when they are undervalued by a market still fixated on the old regime. It has a long-time horizon. It is patient. Late capital is reactive. It rushes in after the trend is obvious, buying assets at elevated prices, driven by fear of missing out. It is often caught on the wrong side of the cycle when the inevitable corrections occur. The rewards for foresight in these moments are immense. In the next part of this video, we're going to look closely at what actually drives productivity. We will move beyond theory and examine the specific technologies and trends, from semiconductors and artificial intelligence to the energy transition and the reorganization of global supply chains. We will explore why capital efficiency, the art of getting more economic output from every dollar of investment, may be the most powerful and most misunderstood force in the economy today. Because growth does not come from optimism. It does not come from hope or hype. It comes from structure. It is built piece by piece through better processes, better tools, and better ideas. It is the result of a system that is fundamentally more capable, and understanding that structure is the first step toward navigating the new landscape that may be emerging before our eyes. To understand why potential growth might be rising, we need to talk about productivity. For decades, economists in many developed nations have been concerned about a slowdown in this crucial metric. Potential growth is like an economy's speed limit, the maximum rate it can expand without triggering runaway inflation. A lower speed limit means a future of slower wage growth, tighter government budgets, and more difficult trade-offs. But what if that speed limit is starting to increase? The key to that question, the variable that underpins our entire capacity for sustainable progress, is productivity. Yet, productivity is one of the most misunderstood ideas in economics. It's a term that gets thrown around in boardrooms and political debates, but its true meaning is often lost in translation. The common narrative, amplified by a culture that often glorifies sheer effort, is that productivity is all about working harder. We picture longer hours at the office, more pressure to hit targets, and a relentless push for more output at any cost. This is the brute force approach. If you want to produce more, you simply put in more effort. You stay an extra hour, you skip a break, you push your team to the brink. While this might yield a temporary bump in output, it's a deeply flawed and unsustainable model for growth. It leads to burnout, diminishing returns, and an increase in errors. It's a model of linear effort, not exponential improvement. But real sustainable productivity has almost nothing to do with individual effort or exhaustion. It's about working smarter, not harder. It's about changing the system, not just pushing the people within it. At its core, productivity is a simple ratio. It's about how much value is created for every single unit of input. Think of it this way. Imagine a factory that produces 100 widgets in an 8-hour shift with 10 workers. The output is 100 widgets. The labor input is 80 worker hours. The productivity is 1.25 widgets per worker hour. Now, if the manager tells everyone to work a 10-hour shift and they produce 125 widgets, the total output is higher, but the productivity, the rate of output per hour, remains exactly the same. Everyone is just more tired. But what if we introduce a new, more efficient machine? Now, the same 10 workers in the same 8-hour shift can produce 200 widgets. The inputs, the worker hours, haven't changed, but the output has doubled. Productivity has skyrocketed to 2.5 widgets per worker hour. That is a genuine productivity gain. The system itself has become more effective. This is the magic of productivity, creating more value without proportionally increasing the resources consumed. And the inputs in this equation are more than just labor. They are all the resources an economy consumes to generate value. The most fundamental inputs are time, labor, capital, the machinery, buildings, and financial resources we deploy, and energy, the literal power that fuels our industries. In the modern era, we must add a fifth crucial input: compute. The processing power, data storage, and network bandwidth that have become the central nervous system of the global economy. When productivity rises, it means we are getting more value out of some or all of these inputs. It means a software update allows a factory to reduce waste. It means a logistics algorithm finds a shorter delivery route, saving fuel and time. It means an AI assistant helps a designer create concepts in half the time. The same system, the same collection of people and capital, suddenly produces more value without requiring proportionally more resources. The entire economic engine becomes more efficient. This is the critical difference between growth that strains an economy and growth that strengthens it. Growth from simply adding more labor or working longer hours is fragile. It hits natural limits quickly and often creates inflationary bottlenecks. But growth driven by productivity is resilient. It expands the economy's capacity, allowing for higher growth and better living standards without overheating. It is the foundation of durable, long-term prosperity. Understanding this distinction is the first step to seeing where the global economy might be headed next. For most of modern history, productivity improvements came from physical advances: machines, factories, transportation, infrastructure. These changes were visible. You could see them. You could touch them. Today, productivity improvements are quieter. They happen inside software, inside logistics systems, inside decision-making processes, inside capital allocation models. This makes them harder to recognize in real time. But their impact is no less real. While a factory or a machine is a visible, tangible asset, a software platform or a data pipeline is an intangible one. You can't touch the code that runs a global logistics network or the algorithm that recommends a product to millions of users simultaneously. Yet, these intangible assets are the engines of a profound economic transformation. They are rewriting the fundamental rules of business growth and value creation. This new paradigm is built on a simple but revolutionary concept: scaling without friction. In this new era, modern businesses can now scale revenue without scaling costs at the same rate. This is the holy grail of corporate finance, a phenomenon known as operating leverage. But what we are witnessing today is operating leverage on an unprecedented scale, supercharged by digital technology. The core idea is the decoupling of growth from the traditional inputs of labor and physical capital. A business no longer needs to build a new factory for every 1,000 new customers, or hire a new salesperson for every new territory. Through digital platforms and networks, a company can reach millions of customers with marginal costs that approach zero. Think about it. Once a piece of software is developed, the cost to deliver it to the 10,000th customer is virtually identical to the cost of delivering it to the 10 millionth. The code is simply copied. There is no additional raw material, no extra shipping container, no new assembly line required. This is the magic of zero marginal cost distribution. Let's contrast this with a traditional business. Consider a classic car manufacturer. To produce one more car, they need more steel, more rubber, more glass, and more labor hours. The cost of producing the 1,000th car is significant. Now, consider a software as a service, or SaaS company. Their primary costs are upfront: research, development, and the initial server infrastructure. Once the platform is live, adding a new user costs next to nothing. This difference is starkly visible in their financial statements. A mature manufacturing company might celebrate a gross margin of 30 to 40%. A successful SaaS company, on the other hand, routinely achieves gross margins of 80% or higher. This isn't just a minor difference. It's a fundamental shift in the economic model of a firm. That was not possible in previous economic eras. The industrial age was defined by physical constraints and linear scaling. To double your output, you had to roughly double your inputs. Growth was a story of tangible expansion: more factories, more machines, more workers. Each step of growth introduced friction, logistical challenges, supply chain bottlenecks, and rising labor costs. The economy of scale was real, but it had clear limits. You could only build a factory so big or run a production line so fast before diminishing returns set in. Today, the digital economy is defined by network effects and exponential scaling. The value of a network, like a social media platform or a payment system, often grows faster than the number of its users. Each new participant makes the service more valuable for everyone else, creating a powerful, self-reinforcing flywheel. This dynamic, combined with near-zero marginal costs, allows companies to grow at a speed and scale that would have been unimaginable just a few decades ago. The limits to growth have become softer, more abstract, and far more distant. This shift changes the relationship between growth and inflation. At a macroeconomic level, the ability to scale without friction acts as a powerful disinflationary force. Traditionally, rapid economic growth would quickly run into capacity constraints. Factories would run at full tilt, the demand for raw materials would spike, and a shortage of skilled labor would drive up wages. This combination of bottlenecks would inevitably lead to rising prices across the economy, what economists call demand-pull inflation. Central banks would then be forced to raise interest rates to cool down the economy, often triggering a recession. But when production scales efficiently, this dynamic is altered. The economy's speed limit, the maximum rate it can grow without stoking inflation, is effectively raised. Prices do not need to rise as quickly because supply can expand almost instantaneously to meet new demand. Margins do not need to compress as aggressively because the cost of serving additional customers is minimal. And labor constraints do not bind as tightly because much of the value is generated by software and automated systems, not by manual effort. This creates a more resilient economic environment, one where growth can be stronger and more sustained, without the immediate threat of overheating. The trade-offs that have defined economic policy for a century are becoming softer, and the entire system is becoming more robust. To understand the resilience of an economy or a company, we must look beyond the headline numbers of growth. We need to examine the engine that drives it. This is where the concept of capital efficiency enters the picture. It's a fundamental principle that separates sustainable progress from fragile expansion. It's the difference between building on solid rock versus building on sand. So, what is capital efficiency? At its core, capital efficiency is not about having more capital. It's about using capital better. It measures how much output, how much value, a business or an economy generates for every dollar of capital invested. Think of it as the productivity of your money. Is each dollar working hard, generating strong returns that can be reinvested? Or is it sitting idle, or worse, being consumed just to maintain the status quo? To make this tangible, investors and analysts use several key metrics. One is return on invested capital, or ROIC. This tells you how much profit a company generates for every dollar that shareholders and lenders have put into the business. A high ROIC suggests a strong business model and a durable competitive advantage. Another metric is asset turnover. This measures how effectively a company uses its assets, like factories, equipment, and inventory, to generate sales. A company that can generate high sales from a small asset base is highly efficient. In the world of technology and services, we look at metrics like the customer acquisition cost, or CAC, payback period. This is the time it takes for a company to earn back the money it spent to acquire a new customer. A shorter payback period means the company can recycle its capital back into growth much faster. And finally, a simple but powerful measure, revenue per employee. This indicates how much revenue the company generates for each person on its payroll, a direct proxy for the productivity of its human capital. Together, these metrics paint a detailed portrait of a system's internal health. In inefficient systems, these numbers look weak. Growth requires constant, brute force injections of capital. To expand, the company must engage in more spending. To fund that spending, it needs more borrowing. To secure that borrowing, it often needs more leverage. This creates a precarious cycle. The business becomes a capital furnace, constantly consuming cash just to keep the lights on and grow incrementally. Each step forward requires a huge, costly effort. This is the inefficient flywheel. It's heavy, rusted, and full of friction. Every push is a struggle. Growth is linear and expensive. The returns generated from one turn are not enough to make the next turn any easier. The system doesn't build momentum. Instead, it builds obligations. Debt accumulates, margins get compressed by rising costs, and the organization becomes complex and slow to react. It is fragile, vulnerable to any disruption in the flow of external capital. In efficient systems, the dynamic is completely different. Growth comes from optimization. It comes from better deployment of existing resources. It comes from smarter allocation of every dollar and every hour. Technology, streamlined processes, and data-driven decisions reduce waste and amplify output. The focus shifts from how much can we spend to how much can we achieve with what we have. This is the efficient flywheel. It's light, well-oiled, and designed for momentum. The initial investment creates returns, but crucially, it also generates data, learning, and process improvements. These intangible assets reduce the friction for the next rotation. As a result, each subsequent turn is faster and more powerful than the last. Capital does more work with less friction. This creates a positive feedback loop where success begets more success. This distinction matters deeply for long-term investors, policymakers, and business leaders. It's about understanding the quality of growth, not just the quantity. An economy growing at 3% with high capital efficiency is far more robust than one growing at 5% through a massive, inefficient credit boom. The first is building lasting capacity. The second is borrowing from the future, because capital efficiency directly reduces the risk that growth will collapse under its own weight. It acts as a structural stabilizer. An efficient system has buffers. It has flexibility. It has the financial and operational capacity to absorb shocks, adapt to changing conditions, and continue performing. It is fundamentally more resilient. When systems are inefficient, growth itself creates instability. This is a critical paradox. The very act of expanding introduces fragility. Debt rises faster than output, creating a leverage problem. Returns diminish as the company is forced to chase lower quality opportunities just to keep growing. The system becomes rigid and overextended. Consequently, corrections become severe. A small disruption in sales or a rise in interest rates can trigger a cascade of failures. When systems are efficient, growth becomes self-reinforcing and stabilizing. The positive flywheel effect takes over. Returns improve, not diminish, as the company leverages its data and scale advantages. Balance sheets strengthen as profits are retained rather than consumed by interest payments. And because the system is not dependent on a constant flow of cheap external capital, market volatility becomes more manageable. The company can navigate economic cycles from a position of strength, not desperation. Now, this does not eliminate risk. No system is immune to failure or disruption. Instead, efficiency changes its shape. The primary source of danger shifts. In an inefficient system, the risk is often internal and financial, the risk of leverage, illiquidity, and insolvency. In a highly efficient system, the risk becomes more external and strategic. It might be the risk of a new technology making your optimized process obsolete, or the risk of concentrating too much reliance on a single platform or supplier. The system is robust, but it may not be anti-fragile. The nature of what can go wrong simply evolves. Understanding this evolution is key to navigating the modern economic landscape. One of the most important developments in modern productivity is the compression of decision time. Businesses today can analyze data, adjust pricing, reallocate resources, and respond to demand in near real time. In older systems, decisions were slow, feedback loops were long, mistakes persisted. Today, inefficiencies are identified and corrected faster. This reduces waste. It reduces misallocation. It improves output without increasing pressure. From a macro perspective, this raises the economy's capacity. Not because people are working harder, but because systems are wasting less. Another underappreciated driver of productivity is organizational efficiency. Companies are flatter. Information is more accessible. Coordination costs are lower. This allows smaller teams to generate disproportionate impact. It also allows capital to flow toward productive uses more quickly. Capital that is poorly allocated does not stay hidden as long as it once did. Markets adjust faster. Signals are clearer. Feedback is sharper. Again, this is not about perfection. It's about improvement. Incremental improvements in efficiency compound over time, just like investments. This is why economists pay attention to productivity trends, even when they don't show up dramatically in headlines. Productivity is slow, but it is relentless. And over long periods, it dominates outcomes. Now let's connect this to potential growth. If productivity improves, the economy's speed limit increases. It can grow faster without triggering inflation, without forcing aggressive tightening, without creating instability. This does not mean interest rates disappear. It does not mean cycles vanish. It means the trade-offs soften. This is a crucial distinction. Many investors assume the economy operates under fixed constraints. That growth must always be punished. That expansion must always be slowed. History shows otherwise. Periods of rising productivity often coincide with periods of sustained expansion and strong real returns. Not because policymakers were generous, but because the system could handle more activity. Capital efficiency also affects how shocks propagate. In inefficient systems, shocks cascade quickly. Stress spreads. Liquidity evaporates. In efficient systems, shocks are absorbed. Buffers exist. Recovery is faster. This matters in a world where uncertainty is constant. Long-term capital is not seeking perfection. It is seeking resilience. And productivity builds resilience. This is why conversations about potential growth are not abstract. They are about the economy's ability to adapt without breaking, to grow without overheating, to absorb stress without collapsing. For investors, this changes how risk should be evaluated. Risk is not only about volatility, it's about fragility. Efficient systems are less fragile. They bend, they adjust, they recover. This does not mean markets will always go up. It means long-term expectations improve, and expectations shape behavior. Businesses invest when they believe capacity exists. Investors commit capital when they believe growth is sustainable. Consumers spend when they feel stability. These behaviors reinforce one another. This is how structural shifts take hold, quietly, gradually, then all at once. In the next block, we're going to connect these ideas directly to markets, stocks, valuations, capital flows. Why investors often misprice environments where potential growth is changing. Because markets don't just react to growth, they react to how fragile that growth appears. And fragility is shaped by productivity and efficiency more than by headlines.
Financial markets are very good at reacting. In fact, one could argue that their primary, moment-to-moment function is reaction. They are a vast, globally interconnected nervous system, designed for instantaneous response. Every flicker of data, every whisper of a rumor, every shift in geopolitical tension is registered and processed in microseconds. High-frequency trading algorithms, which now account for a significant portion of daily volume, are the purest expression of this reactivity. They don't analyze, they don't contemplate. They execute based on pre-programmed responses to specific data inputs, operating on timescales far beyond human comprehension. This system is a marvel of engineering, built for speed and efficiency in processing information. It ensures that any new public knowledge is, in theory, immediately reflected in the price of an asset. A surprisingly strong jobs report, a sudden change in a central bank's tone, an unexpected product announcement from a major technology firm. The market's response is swift and decisive. This is the world of the ticker tape, the world of breaking news alerts and flashing red and green numbers. It is a world governed by the immediate, but they are not always good at understanding. This is the fundamental paradox of modern markets. For all their computational power and speed, they often fail to grasp the deeper, more complex currents that shape our economic reality. Understanding is a fundamentally different cognitive process than reacting. It requires context, patience, and the ability to synthesize disparate information over long periods. It involves looking beyond the immediate data point to see the trend, and looking beyond the trend to see the underlying structural forces at play. While a market can react to a single earnings report in a nanosecond, it can take months or even years to truly understand a company's shifting competitive advantage, the maturation of a new technology, or the long-term implications of a new government policy. This distinction between reaction and understanding is not merely academic. It is the primary source of both risk and opportunity for the long-term investor. The market's focus on the immediate creates a persistent gap between short-term price and long-term value. Prices move quickly. They are the most visible and immediate manifestation of the market's reactive nature. A stock can gain or lose billions of dollars in market capitalization in a matter of minutes based on a single headline. This volatility is often driven by sentiment and momentum as much as by fundamental analysis. Algorithmic trading exacerbates this, creating feedback loops where buying begets more buying and selling triggers further selling, often disconnected from any change in the underlying business's intrinsic worth. The price you see on the screen at any given moment is simply the last point of transaction, a temporary consensus between the most eager buyer and the most motivated seller. It is a signal, but it is a noisy one, often reflecting fear, greed, and short-term speculation more than a sober assessment of future cash flows. Narratives form quickly. In a world saturated with information, the human mind seeks simple, compelling stories to make sense of complexity. The financial media and online discourse are factories for these narratives. A company is either a disruptor or a dinosaur. An economy is heading for a soft landing or a hard recession. These stories are powerful because they are easy to grasp and share. They can take hold with incredible speed, driving investor behavior and becoming self-fulfilling prophecies in the short term. A positive narrative can attract a flood of capital, pushing prices up and validating the story, while a negative one can create a crisis of confidence. The problem is that these narratives are often oversimplifications. They tend to extrapolate the most recent events into the indefinite future and ignore the nuances and countervailing forces that are always present. Expectations adjust quickly. Wall Street operates on a rhythm of quarterly earnings and forward guidance. Analyst expectations for a company's future performance are constantly being revised based on the latest data points and management commentary. This creates a relentless focus on the next 3 months. A company that beats its quarterly earnings estimate but provides slightly weaker guidance for the next quarter can see its stock punished severely. This cycle forces corporate management teams to prioritize short-term performance, sometimes at the expense of long-term investment and strategic positioning. The collective expectations of the market, therefore, tend to be myopic, anchored to a very near-term horizon, and prone to significant swings based on small deviations from a predicted path. But structure changes slowly. This is the other side of the coin, the slow-moving foundation upon which the frenetic activity of the market takes place. Structural changes are the deep, powerful, and enduring shifts that redefine the landscape of the economy and society. These are not the events of a single quarter. They are the trends of a generation. Think of demographic shifts, like an aging population or the rise of a new middle class in an emerging market. Think of technological platforms, like the build-out of the internet, the transition to cloud computing, or the current diffusion of artificial intelligence. Consider the slow evolution of public policy and regulation, the reconfiguration of global supply chains, or the multi-decade transition in our energy systems. These forces move at a geological pace compared to the frantic speed of the market. This creates a gap between what is happening and what is being priced. This temporal mismatch is the central inefficiency that a patient, long-term investor can exploit. The market, with its obsession with the next data point, consistently underprices the impact of these slow-moving structural changes. It struggles to incorporate trends that unfold over 5, 10, or 20 years into a valuation model that is judged on its performance over the next 3 months. The value of a transformational technology, the earning power of a company exposed to a major demographic tailwind, the resilience of a business with a newly fortified supply chain. These are often invisible to a market looking for the next immediate catalyst. This gap is a quiet space, away from the noise of daily commentary, where true understanding can lead to superior returns. It is the difference between the stock price and the enterprise's true underlying trajectory. When investors talk about growth, their language often reveals this short-term bias. The conversation is dominated by cyclical, not structural factors. They usually focus on near-term indicators. The entire ecosystem of financial analysis is built around this cadence. Sell-side analysts, portfolio managers, and the financial press are all caught in the same gravitational pull of the immediate future. Success is often defined by correctly predicting the next few moves of the market, not by correctly identifying the long-term winners in the economy. This institutional imperative creates a powerful incentive to focus on what is knowable and imminent, rather than what is important but uncertain and distant. Earnings reports. The quarterly earnings release is the focal point of this cycle. It is a moment of reckoning where a company's performance is judged against a set of precise, preordained expectations. The focus is intense, but also incredibly narrow. Did the company beat revenue estimates by 1% or 2%? Were margins slightly above or below consensus? This microscopic analysis of the past 90 days often overshadows the more important strategic questions about the company's direction over the next 90 months. Economic releases. Similarly, the monthly calendar of economic data, inflation, employment, retail sales, manufacturing indices, creates a steady drumbeat of news that the market feels compelled to react to. Each release is dissected for clues about the health of the economy and the likely next move of the central bank. This is the data-dependent world we live in. But each data point is a snapshot, a single frame in a very long movie. It is often subject to revision and can be influenced by temporary factors like weather or seasonal quirks. Over-focusing on any single release can lead to a distorted view of the underlying economic trend. Short-term forecasts. Based on this flow of information, analysts produce a constant stream of forecasts for the next quarter or the next year. These forecasts are essential for setting expectations, but they are notoriously difficult to get right and tend to be extrapolations of the recent past. They are far more effective at capturing cyclical momentum than they are at identifying structural turning points. The consensus forecast often misses the big shifts, precisely because those shifts have not yet shown up in the recent data that the models are trained on. These signals matter. To be clear, the argument is not to ignore this information. A successful investor cannot be blind to the present. Earnings reports and economic data are vital pieces of the puzzle. They provide a real-time check on a company's execution and the health of the broader economy. They are essential for assessing risk and understanding the current sentiment of the market. A long-term thesis must be robust enough to withstand the inevitable bumps and surprises that these short-term signals will reveal. The key is not to disregard them, but to place them in their proper context. But they are incomplete. They represent the trees, not the forest. They tell you about the weather today, but not about the changing climate. Relying solely on these signals is like trying to navigate a ship across the ocean by looking only at the waves hitting the bow. You might avoid the next immediate crest, but you will have no idea if you are heading towards a distant storm or a safe harbor. A complete picture requires a different kind of map, one that charts the deeper currents of structural change. Markets often struggle to price environments where potential growth is shifting. This is where the reactive model truly breaks down. When the fundamental capacity for growth in an economy or an industry is itself changing, historical data and short-term forecasts become unreliable guides. The market is good at pricing a stable world with predictable cyclical fluctuations. It is far less adept at pricing a world in transition. It may underappreciate the dawn of a new productivity cycle driven by technology, or it may fail to recognize the permanent impairment of an industry facing a structural headwind. Why? Why does this inefficiency persist in such a sophisticated and competitive environment? The reasons are both psychological and structural. Because structural change does not announce itself clearly. There is no press release for the beginning of a productivity revolution. There is no single government report that confirms a permanent shift in consumer behavior. These changes emerge quietly, from the bottom up, across thousands of companies and millions of individuals. They are a mosaic of small, incremental developments that only form a clear picture in hindsight. It does not arrive in a single data point. A structural trend is, by definition, a series of data points moving in a new, persistent direction. Any single point can be dismissed as noise, an anomaly. The human brain, and the market's collective brain, is wired with a strong sense of normalcy bias. We tend to assume that the future will look much like the recent past. It takes an overwhelming amount of evidence to convince us that the underlying regime has changed. It does not confirm itself in one quarter. The tyranny of the quarterly reporting cycle means that if a new trend doesn't immediately translate into higher revenues or wider margins within 90 days, it is often dismissed. But the investments required to capitalize on structural change, building a new factory, developing a new software platform, entering a new geographic market, often take years to bear fruit. They require a period of investment that may depress short-term results, making the company look unattractive to a market focused on immediate gratification. It unfolds gradually. This is the most crucial attribute. Structural change is a process, not an event. It is the slow accumulation of competitive advantage, the gradual adoption of a new technology, the patient work of building a brand. And because it is gradual, its full impact is consistently underestimated by a market that craves speed and certainty. This creates the opportunity for the investor who is willing to trade the illusion of short-term certainty for the potential of long-term understanding. It requires a shift in perspective, to see time not as an enemy, but as an ally. During these transitions, when the very architecture of the economy is being redrawn, the market's character changes. It becomes a crucible of competing narratives, a space where long-term structural shifts collide with the immediacy of human emotion. These are not mere cyclical adjustments. They are fundamental reconfigurations driven by technology, demographics, and global supply chains. And it is within the turbulence of these periods that the distinction between signal and noise becomes most critical and most difficult to discern. The daily, weekly, and even quarterly movements of asset prices generate a constant stream of information, what we call noise. This noise is compelling. It is amplified by financial media, debated by analysts, and acted upon by algorithms, creating a powerful feedback loop. Human psychology is hardwired to react to these immediate stimuli. We are conditioned by recency bias, giving undue weight to the latest data point, and by loss aversion, feeling the pain of a small loss more acutely than the pleasure of an equivalent gain. This creates a fertile ground for volatility. In this environment, markets oscillate between optimism and doubt. This is not a smooth, rational process of price discovery. It is a frantic, emotional pendulum swing. A single positive economic print can ignite a rally built on fragile confidence as investors rush in, fearing they will miss out on the recovery. Conversely, a minor geopolitical headline or a slightly disappointing earnings report can trigger a cascade of selling as fear of a downturn becomes a self-fulfilling prophecy. The market develops a bipolar personality, lurching from euphoria to despair, often within the same trading week. This oscillation is exhausting, and it distorts perception. It forces a short-term focus, because the long term seems impossibly uncertain when the present is so volatile. Within this cycle, every slowdown feels like failure. A dip in manufacturing output is not seen as a temporary adjustment, but as the first sign of a deep recession. A company missing its quarterly revenue target is not viewed as a minor stumble, but as proof that its growth story is broken. The narrative of secular stagnation takes hold, and every piece of negative data is interpreted as confirmation. The market extrapolates a single point of weakness into a permanent, downward trajectory. This is the voice of doubt, and it is loud, persuasive, and backed by a chorus of cautious commentary. And yet, on the other side of the pendulum, every acceleration feels unsustainable. A strong jobs report is immediately followed by fears of an overheating economy. A stock that doubles is reflexively labeled a bubble, detached from fundamentals. The market becomes conditioned to wait for the other shoe to drop. This is the voice of optimism, but it is a nervous, fleeting optimism, constantly looking over its shoulder for the inevitable correction. The memory of the last downturn is too fresh, and the belief that strong growth must be punished by inflation and higher rates is deeply ingrained. But beneath that noise, a more powerful, more persistent force may be at work. While the market is consumed by its own emotional cycles, the real economy may be undergoing a quiet revolution. Capacity may be expanding. New factories are being built with higher levels of automation, capable of producing more goods with fewer resources. Software platforms are creating leverage, allowing businesses to scale services to millions of users with minimal incremental cost. Advances in artificial intelligence are not just optimizing processes, but creating entirely new categories of productivity. This expansion of the economy's productive capacity is a structural change. It is slow, methodical, and often invisible to those focused on the daily market chatter. It is the signal, drowned out by the noise. This is where mispricing occurs. A fundamental disconnect emerges between the market's perception of value, which is shaped by short-term sentiment, and the underlying reality of value, which is being driven by these long-term structural improvements. The market is pricing assets for a world of scarcity and cyclical volatility, while the real economy may be building a world of abundance and efficiency. This gap between perception and reality is the source of profound opportunity for the patient investor. It is a window where assets are valued not on their future potential, but on the market's current fears. When investors assume growth will be punished by inflation and tightening, they are operating from a playbook written for a previous economic era. This playbook states that strong demand inevitably outstrips supply, leading to rising prices. Central banks, in turn, must raise interest rates to cool the economy, choking off growth in the process. It's a zero-sum game where growth is its own undoing. This assumption becomes the default lens through which all data is viewed. Consequently, they demand higher risk premiums. The perceived risk of owning equities or corporate bonds rises because the future is seen as a minefield of inflation shocks and policy tightening. Investors require a greater potential return to compensate them for taking on this perceived risk. This isn't a calculated analytical adjustment, it's an emotional one. It's the price of fear. The risk premium becomes a buffer against uncertainty, and in a period of transition, uncertainty feels infinite. They compress valuations. A higher risk premium directly translates into a lower valuation multiple. A company projected to earn $1 in the future is worth less today if that future is discounted at a higher rate. The market, in effect, pays less for the same stream of future earnings. Price-to-earnings ratios contract. Enterprise value to sales multiples fall. The entire valuation framework is squeezed downward by the weight of pessimism, even for companies whose fundamental prospects are improving. And critically, they shorten time horizons. When the near term is dominated by fear, the long term becomes an academic abstraction. Why model a company's cash flows 10 years from now when the market is panicking about next quarter's inflation print? The focus collapses to the immediate future. The value of durable, long-term growth is heavily discounted, while the value of near-term certainty is prized above all else. The market becomes myopic, trading the promise of a forest for the security of a single tree. But if productivity and efficiency are improving, this entire chain of logic begins to break down. If the economy can produce more with less, then growth is not inherently inflationary. It is disinflationary. If technology allows a company to serve twice the customers with the same cost base, its margins expand, and its growth becomes more profitable and durable. The old playbook, which assumes a trade-off between growth and stability, no longer applies. The assumptions that led to higher risk premiums, compressed valuations, and shortened time horizons may be outdated. The market is fighting the last war, while the new one is being won on a different battlefield. A battlefield of innovation, efficiency, and expanding capacity. Recognizing this disconnect is the first step toward navigating the noise and capitalizing on the transition. When we observe markets rewarding companies with seemingly high valuations, the immediate reaction is often one of skepticism. A common critique is that we are witnessing a departure from fundamental principles, a speculative bubble where prices have detached from reality. However, this interpretation, while tempting, can be a significant oversimplification. The core issue may not be that valuations should be extreme or that traditional discipline no longer applies. Instead, it suggests that our valuation frameworks themselves must adapt. The tools and mental models that served us well in a previous economic regime, one characterized by stable supply chains, predictable inflation, and incremental technological change, may be ill-equipped to accurately price the structural winners of a new era. When the underlying economic structure shifts, so too must the lens through which we assess value. Sticking rigidly to outdated models is like using a map of the old world to navigate a newly discovered continent. It doesn't lead to prudence, it leads to getting lost. This is where the philosophy of the long-term investor diverges sharply from that of the short-term trader. Long-term investors inherently focus less on momentum, the noise of quarterly earnings beats, analyst upgrades, or fleeting market sentiment. These are temporary signals, often reflecting transient conditions rather than fundamental shifts in a company's long-term trajectory. Instead, their focus shifts decisively toward durability. Durability is the capacity of a business to sustain and grow its earnings power across economic cycles. It is a measure of resilience, competitive advantage, and structural relevance. It is the quality that allows a company not just to survive turbulence, but to emerge stronger from it. To assess this durability, they ask a different set of questions that probe the very architecture of the business. The first question is foundational. Can this system support expansion? This goes beyond simply asking if a company can sell more products next quarter. It examines the scalability of the entire business model. Does the company have the operational leverage, the technological infrastructure, and the supply chain integrity to grow its output by 10 or 100 times without a proportional increase in complexity or cost? A business built on a scalable platform, whether it's software, a logistics network, or a franchise model, possesses a structural advantage that a business reliant on linear, manual effort does not. The second question targets profitability. Can margins hold? Or, even better, can they expand with scale? Margin durability is a critical indicator of a company's pricing power and competitive moat. A business that must constantly lower prices to gain market share has a fragile position. In contrast, a company with a strong brand, proprietary technology, or a network effect can often maintain or even increase its margins as it grows. We must analyze the sources of these margins. Are they protected by high switching costs for customers? Are they the result of a unique, low-cost production process? In an inflationary environment, the ability to pass on rising costs without destroying demand is a powerful form of durability that many traditional valuation models fail to adequately capture. The third question addresses capital efficiency. Can capital compound without constant intervention? This is the essence of a truly great business. It's about the return on incremental invested capital, or ROIC. A company that can reinvest its profits back into the business at a high rate of return is a compounding machine. It requires minimal external capital and little managerial intervention to fuel its growth. This is the opposite of a capital-intensive business that must constantly spend heavily just to maintain its position, with each dollar of growth requiring another dollar of investment. We look for businesses that are capital light, where growth is fueled by intangible assets like code, brand, or intellectual property. These are the systems that generate free cash flow, the lifeblood of long-term value creation. When you frame the analysis around these pillars, scalability, margin durability, and capital efficiency, it becomes clear that these questions matter far more than quarterly surprises. A positive earnings surprise might move a stock for a day or a week, but it tells you very little about the company's ability to generate value over the next decade. It is a snapshot in time, whereas an understanding of the business's structure provides the blueprint for its future. The market, in its collective focus on the near term, often gets this wrong. Markets that misprice durability, that is, they assign a similar valuation multiple to a capital-intensive, low-margin business as they do to a scalable, high-margin one, are creating opportunities. They often underappreciate long-term returns. The compounding power of a durable business is not linear. It is exponential. The market, however, tends to extrapolate linearly. This mismatch between the market's linear expectation and the business's exponential reality is the primary source of alpha for the long-term investor. The value is not created by the market eventually waking up. The value is created by the business itself, year after year, as it executes on its structural advantages. The market's recognition is merely the final step in the process. This is precisely why patient capital consistently outperforms reactive capital over meaningful time horizons. Reactive capital chases headlines. It buys on good news and sells on bad news, perpetually caught in the cycle of market sentiment. It is a strategy defined by motion, but not necessarily progress. Patient capital, on the other hand, is defined by conviction. It invests in a business's underlying structure and gives it time to compound. Its outperformance does not come from a superior ability to forecast the future. Patient capital does not win because it predicts better what the next inflation print will be or whether a recession will arrive in 6 months or 12. It wins because it understands structure. It understands that a business with a deep competitive moat, a scalable model, and high returns on capital is like a well-built fortress. It can withstand the sieges of economic downturns, competitive attacks, and shifting sentiment. While others are distracted by the battles raging outside the walls, the patient investor knows that the true value is being created within, quietly, consistently, and durably. This understanding is the ultimate edge. When potential growth rises, time becomes an ally. Short-term volatility matters less. Compounding matters more. This is uncomfortable for many investors. It requires restraint. It requires longer horizons. But it is precisely how wealth is built. The market is not wrong. It is simply incomplete. And incompleteness creates opportunity. This is the patient investor's edge. Capital allocation is one of the most important forces in any economy. It is the silent, invisible current that directs the flow of resources, shaping our world in ways both profound and subtle. It is the lifeblood of progress, the engine of innovation, and the ultimate arbiter of which ideas flourish and which are left to wither. Where money flows determines what grows, what shrinks, and what survives. This is not merely a transactional process. It is a collective expression of our confidence, our fears, and our vision for the future. Every investment, from a venture capitalist funding a startup to a government issuing a bond for new infrastructure, is a vote cast for a particular version of tomorrow. The aggregate of these decisions creates the economic landscape we all inhabit. In an ideal world, this process is governed by a clear and rational principle: efficiency. In efficient systems, capital flows toward productivity. It seeks out ventures that are not just profitable, but fundamentally sound. It is drawn toward durability, favoring businesses and projects with resilient models and a clear path to sustainable operation. Above all, it is guided by the principle of long-term value creation, understanding that the greatest returns are cultivated over time, not seized in a moment. Think of the foundational investments that built the modern world: the sprawling rail networks of the 19th century, the electrification of continents, the development of the semiconductor. These were not short-term plays. They were monumental allocations of capital, predicated on a deep-seated belief in a more productive, more connected future. The investors and builders behind these projects understood that they were laying groundwork, creating platforms upon which decades of subsequent innovation could be built. This is capital allocation at its most powerful, as a tool for civilizational advancement. But the world is not always ideal. Systems can, and often do, become inefficient. In inefficient systems, capital behaves very differently. It loses its long-term perspective and begins to chase short-term signals. The steady pursuit of value is replaced by the frantic chase for momentum. The dominant forces are no longer productivity and durability, but speculation, leverage, and noise. Here, capital is not a tool for building. It is a token in a game of rapidly shifting perceptions. It flows not to the most promising enterprises, but to the most talked about assets. It is amplified by leverage, creating fragile, towering structures of debt built on a foundation of fleeting sentiment. This is the world of speculative bubbles, from the Dutch tulip mania of the 17th century to the dot-com boom of the late 1990s. In these periods, the intrinsic value of an asset becomes secondary to the belief that someone else will be willing to pay more for it tomorrow. The market becomes a hall of mirrors, reflecting not the real economy, but its own distorted expectations. The difference matters. It is the difference between building a robust industrial base and fueling a fleeting market frenzy. It is the difference between sustainable growth and a cycle of boom and bust. When an economy is dominated by short-term speculation, the consequences are severe. The misallocation of capital becomes systemic. When potential growth is misunderstood, capital is often misallocated. This is the critical point of failure. The market's inability to correctly price the future leads to a cascade of poor decisions. Investors, conditioned by volatility and uncertainty, demand quick returns because they fear instability. Their time horizon shrinks. They would rather back a project with a modest, immediate payoff than a transformative one whose benefits will only materialize over a decade. This short-termism starves the very projects that are most essential for long-term prosperity. This fear is contagious. Businesses, in turn, underinvest because they fear a sudden tightening of financial conditions. Why commit to a 5-year factory expansion if you suspect the cost of capital will skyrocket next year, or that consumer demand will evaporate? The rational choice for an individual CEO facing an uncertain environment is to preserve cash, delay major projects, and focus on optimizing for the current quarter. As a result, opportunities are missed. Groundbreaking research sits on the shelf. New infrastructure is never built. Promising companies fail to secure the funding they need to scale. These opportunities are not missed because they are unprofitable, but because they are misunderstood. Their timelines are too long, their payoff profiles too uncertain for a market fixated on the here and now. This is the hidden cost of mispricing growth. It is a tax on the future. When capital is hesitant, systems underperform their potential. The entire economy operates with a handbrake on, capable of so much more, but held back by a collective failure of confidence. Consider the energy sector. The transition to a more sustainable energy system is one of the largest capital allocation challenges in human history. It requires trillions of dollars to be invested in new technologies, from advanced battery storage to next-generation nuclear reactors and green hydrogen production. The long-term value proposition is immense: energy independence, lower environmental impact, and stable, predictable energy costs. Yet for years, capital allocation in this space was hampered by uncertainty. Volatile fossil fuel prices created short-term incentives to stick with the old, while regulatory ambiguity and questions about the scalability of new technologies made investors hesitant. Capital that should have been building the energy infrastructure of the 21st century was instead chasing short-term price swings in oil and gas markets. The system was underperforming its potential, not for a lack of viable technology, but for a lack of confidence in the long-term structure. But when confidence in structure improves, behavior changes. When governments provide clear, long-term policy signals, when technological milestones are demonstrably met, and when the financial architecture is built to support long-duration projects, the calculus shifts. The perceived risk of investing in the future declines. Suddenly, the floodgates open. Businesses invest. They commit to building the gigafactories, the offshore wind farms, the transmission lines. Innovation accelerates as a surge of new funding allows researchers to tackle harder problems and scale up their solutions. And most importantly, productivity compounds. Each new solar panel installed, each improvement in battery efficiency makes the entire system more valuable. The initial investments create a platform for further growth, attracting more capital in a virtuous cycle. This is not optimism. It is feedback. Capital responds to perceived stability. This dynamic is why long-term growth environments often appear boring at first. They lack the drama of a speculative mania. They lack the urgency of a market in panic. There are no wild price swings, no breathless headlines. Instead, there is just the quiet, methodical process of building, the slow, steady accumulation of productive capacity. Think of the development of modern logistics. The revolution in global supply chains wasn't the result of a single dramatic breakthrough. It was the result of decades of incremental improvements. The standardization of the shipping container, the development of computerized inventory management, the optimization of port operations, and the construction of vast warehousing and distribution networks. Each step was a relatively boring investment in efficiency. But compounded over 50 years, these investments completely reshaped the global economy, enabling complex, just-in-time manufacturing and the rise of e-commerce. The system became exponentially more productive, not through frantic activity, but through patient, structural improvement. The same principle applies to the digital world. The build-out of the internet's core infrastructure, the fiber optic cables, the data centers, the server farms, was a monumental, capital-intensive task that took place largely out of the public eye. It was far less glamorous than the consumer-facing apps that would later be built on top of it. But without that boring foundational layer, the vibrant digital economy we know today would be impossible. The value was not in the individual components, but in the compounding productivity of the network itself. This reveals a fundamental truth about markets. They are powerful, but they are not prescient. They are often poor at pricing quiet, structural progress. They are captivated by noise and novelty. Capital that understands this moves early, quietly, without noise. It does not chase headlines, it builds positions. It identifies sectors where the underlying structure is improving, where the potential for compounding productivity is being underestimated. It allocates resources not based on the current narrative, but on a deep analysis of the underlying fundamentals. This is the strategy of patient capital. It is an approach rooted in the understanding that capital efficiency rewards patience. It accepts that in the short term, the market may fail to recognize the value of its investments. The position may underperform, the narrative may be negative, but it maintains its conviction because its analysis is not based on sentiment, but on structure. Because capital efficiency rewards patience, and patience is scarce. Of course, this approach is not without risk. The line between a patient, contrarian investment and a simple mistake can be thin. A thesis about long-term structural change can be wrong. A new technology may fail to achieve commercial scale. A shift in the political or regulatory landscape can undermine the foundation of a multi-decade investment. The risk of being wrong about the future is real. But we must weigh this against the alternative. The cost of being wrong in the short term feels high. It is visible, immediate, and emotionally potent. But the cost of being wrong about structure is much higher. It is the cost of missed decades, of potential left unrealized, of problems left unsolved. That cost is time. Ultimately, the effective allocation of capital is a function of confidence. Not the fleeting emotional confidence of a bull market, but a deeper, structural confidence. Confidence in the rule of law, confidence in institutions, confidence in the idea that productivity will be rewarded and that the future can be built, not just gambled upon. Where this confidence exists, capital is patient. It is productive. It compounds. It transforms potential into reality. Where this confidence is absent, capital is fearful, short-sighted, and inefficient. The challenge for investors and for societies is to cultivate the conditions for this deeper confidence, to build systems that encourage a long-term perspective, and to allocate our most precious resource, capital, not to the loudest voices, but to the most promising futures. When people talk about the economy, they usually talk about events, recessions, recoveries, crashes, rallies. But the economy is not driven by events. It is shaped by cycles. And cycles are not dramatic, they are gradual. In our modern world, we are conditioned to the immediate, the instant notification, the breaking news alert, the daily fluctuation of the market. We measure progress in quarters, and we define trends in months. But the most powerful forces that shape our economic reality operate on a completely different timescale. Long-term economic cycles do not turn on a single day or a single decision. They do not announce their arrival with a trumpet blast or a headline. Instead, they shift quietly, almost imperceptibly, over the course of years, sometimes even decades. They are like the slow, immense pressure of tectonic plates, grinding against each other far beneath the surface. The movement is constant, but it is only when the accumulated stress is released that we feel the earthquake on the surface. By then, the underlying shift has been underway for a very long time. This fundamental mismatch in timing is precisely why most people misunderstand them. Our attention is a finite resource, and the modern information environment is expertly designed to capture it with what is urgent, rather than what is important. We are drawn to the noise, the volatility, the drama of the day-to-day. We look for signals that are too loud, too obvious, too emotional. A sudden market drop is a crisis. A surprising earnings report is a breakthrough. A politician's speech is a turning point. These events feel significant because they are immediate and generate a strong emotional response. They are the visible waves on the ocean's surface, churned up by the winds of daily events. They are easy to see and even easier to react to. But the real transitions, the deep currents that truly dictate the direction of the economy, happen underneath the noise. These are the structural changes in demographics, the slow march of technological integration, the long-term cycles of debt and investment, and the gradual shifts in global trade and geopolitics. These forces don't make for exciting television. They don't fit neatly into a tweet. Think of the decades-long build-out of the interstate highway system after World War II. It wasn't a single event, but a slow, methodical process that fundamentally rewired the arteries of commerce, enabling new industries, creating suburbs, and changing the way Americans lived and worked. The full impact wasn't felt in a single year, but across a generation. Or consider the digital revolution. It began not with the launch of the first iPhone, but with the quiet invention of the microprocessor decades earlier. Its integration into our economy was a slow burn, a gradual accumulation of efficiency and connectivity that eventually reached a tipping point, unleashing a wave of productivity that defined an era. The signs were there, but they were written in the language of engineering papers and niche industry reports, not front-page headlines. Therefore, to truly understand where we are today, and to gain a clearer perspective on where we might be heading, we need to do something that feels unnatural. We need to step back. We must consciously resist the pull of the immediate and zoom out our frame of reference. We need to look past the data of the last few weeks, or even the last few months. The perspective required is not measured in fiscal quarters. It is measured in years, and more often in decades. By adopting this long-term perspective, we can begin to distinguish the signal from the noise. We can start to see the shape of the deep currents moving beneath the turbulent surface. This is the key to navigating the economic landscape, not by reacting to every wave, but by understanding the tide. To truly understand the rhythm of the economy, we must look beyond the daily noise of market fluctuations and political headlines. Beneath the surface, economic cycles are influenced by three deep, powerful, and often invisible forces: productivity, capital efficiency, and expectations. These are not just academic concepts. They are the fundamental drivers that shape our collective prosperity, determining whether we experience periods of vibrant growth or long stretches of stagnation. They are the tectonic plates of our financial world, shifting slowly but with immense consequence. Let's first consider productivity. In its simplest form, productivity is about our ability to do more with less. It's the engine of progress. It's the innovation that allows a farmer to feed 100 families instead of just one, or a factory to produce 1,000 cars in the time it once took to build 10. This force is driven by technology, by better processes, and by a more skilled workforce. When productivity is rising, it creates new wealth, raises living standards, and makes the economic pie bigger for everyone. It is the most fundamental source of long-term growth. The second force is capital efficiency. This is about how wisely we invest our collective resources, our savings, our profits, our national wealth. Capital is the fuel for the economic engine, but it must be directed to the right places. When capital is allocated efficiently, it flows toward productive enterprises, funding new technologies and building infrastructure that will generate real value for decades. Think of it as smart investing on a massive scale. However, when capital is allocated inefficiently, it gets trapped in speculative bubbles, funds unproductive ventures, or props up dying industries. Poor capital efficiency doesn't just waste money, it starves the future of its potential. The third and perhaps most ethereal force is expectations. This is our collective belief about the future. Are we optimistic or are we pessimistic? These beliefs are not passive, they are active agents of change. When we expect the economy to grow, businesses invest, hire new employees, and take risks. Consumers feel confident and spend. This collective optimism can become a self-fulfilling prophecy, creating the very growth we anticipated. Conversely, when expectations are low, the opposite happens. Businesses hoard cash, consumers save fearfully, and the economy contracts under the weight of its own pessimism. Expectations are the psychological tide that can either lift all boats or leave them stranded on the sand. When these three forces align, growth feels natural. It feels effortless. Imagine a period of high productivity, where new technologies are booming. This is combined with efficient capital allocation, as investment pours into these promising new sectors. And it's all supercharged by soaring expectations, as everyone sees a bright future ahead. In these golden eras, the economy doesn't just grow, it compounds. Progress feels inevitable, but when they misalign, growth feels fragile. It feels forced and uncertain. Productivity might be stagnating, while capital is being poured into a housing bubble driven by overly optimistic expectations. Or perhaps a new productivity wave is beginning, but capital is slow to move, and expectations remain stubbornly low, trapped by the memory of a past recession. In these times, any small shock to the system can feel like a major crisis, because the underlying foundation is unstable. For long periods of time, the economy can appear stuck. Growth feels constrained, returns feel compressed, confidence feels low. During these phases of misalignment, it's easy to become cynical. It feels as though the rules have changed, that the potential for real progress has vanished. The headlines are filled with stories of stagnation, and the prevailing mood is one of quiet resignation. It's a landscape where ambition seems pointless, and caution is the only sensible strategy. But that does not mean the system is broken. This is a critical point. What feels like a breakdown is often a necessary, albeit uncomfortable, period of transition. It often means the system is reorganizing. Beneath the surface of low growth and pessimism, the groundwork for the next era is being laid. Old, inefficient industries are slowly giving way. Capital is cautiously beginning to shift away from the failures of the past. Innovators are quietly developing the technologies that will fuel the next wave of productivity. This reorganization is slow, messy, and largely invisible to the casual observer. It doesn't make for exciting news, but it is profoundly important. It is the process of clearing away the debris of the old cycle to make room for the new. This is why every major economic era begins with confusion. It begins when the old narratives no longer fit the reality, but the new narrative has not yet emerged. It is a time of profound uncertainty, where the signals are mixed and the path forward is unclear. But it is in this very confusion that the seeds of the next great alignment are sown, waiting for the moment when productivity, capital, and expectations finally click into place once more. History teaches us a humbling lesson. The most profound transformations are almost never recognized in the moment. They arrive not with a thunderous announcement, but as a quiet, incremental tide. The industrial age, for instance, was not immediately understood as a revolution. To those living through its early days, it was a collection of noisy, dirty factories, a localized phenomenon of steam and steel. It was seen as an evolution of craft, not a fundamental reshaping of human society, labor, and the very concept of wealth. The decades-long lag between the invention of the steam engine and its widespread economic impact is a testament to this perceptual delay. Contemporaries saw disruption and chaos, not the dawn of a new economic paradigm that would lift millions from poverty and redefine the global order. They anchored to the familiar world of agriculture and artisans, unable to grasp the scale of the change unfolding before their very eyes. Similarly, the great post-war expansion was not obvious in real time. In the late 1940s, the dominant narrative was one of caution and fear. Economists and policymakers, their minds seared by the memory of the Great Depression, widely predicted a return to economic stagnation as wartime spending ceased. They saw millions of returning soldiers as a potential unemployment crisis, not the engine of a new consumer class. Yet, beneath the surface of this anxiety, the seeds of an unprecedented boom were sprouting. New technologies forged in the war, from aviation to synthetics, were being repurposed for civilian life. A surge in household formation and the development of the suburbs created immense, unpredicted demand. The prevailing wisdom saw only the ghosts of the past, while a new reality of broad-based prosperity was quietly being built, house by house, highway by highway. And more recently, the digital transformation was underestimated for years. In the early 1990s, the internet was largely viewed as a niche hobby for academics and enthusiasts, a fad. The idea that this clunky, slow network of computers would one day mediate our social lives, our commerce, and our media was considered science fiction. Even as adoption grew, its true potential was misunderstood. Businesses saw it as a digital brochure, a new channel for marketing, not a force that would fundamentally re-architect entire industries, from retail to entertainment. The productivity paradox of the era, where massive investment in computing power showed little initial impact on economic statistics, fueled the skepticism. The market, and society at large, was projecting the linear progress of the industrial world onto an exponential technology. These transitions feel uncomfortable because they challenge our most deeply held assumptions. Our understanding of the world is built on a framework of past experiences. We create mental models based on what has worked, what has been true, for years or even decades. A true structural shift doesn't just change the data, it breaks the model itself. It renders the old maps obsolete. This creates a profound sense of cognitive dissonance. The familiar rules of cause and effect no longer seem to apply, leading to a period of confusion and disorientation. It's in this gap, between the fading relevance of the old paradigm and the slow recognition of the new one, that misperception thrives. Faced with this uncertainty, people anchor to the past. It's a natural human tendency. The past is known, tangible, and feels safe. We use it as a reference point for the future, a psychological safe harbor in a storm of change. They assume yesterday's limits still apply. If growth has averaged 2% for a decade, we instinctively believe it will continue to do so, even as the underlying drivers of that growth are being completely rewritten. They project recent experiences forward. This is recency bias, the belief that what has just happened will continue to happen. A few years of low inflation, and we begin to believe high inflation is impossible. A decade of tech dominance, and we assume it is a permanent state of affairs. This linear extrapolation of the recent past is one of the most fundamental errors in forecasting. This is one of the most persistent and costly mistakes investors make. Markets are forward-looking, but the humans who participate in them are often backward-looking. This mismatch is a primary source of both bubbles and busts. When investors anchor to a past era of stability, they underestimate the potential for disruptive innovation, leading them to miss out on generational opportunities. Conversely, when they project a recent euphoric bull market indefinitely into the future, they become blind to rising risks and valuations, setting the stage for a painful correction. The emotional toll is immense, but the financial consequences can be devastating, derailing long-term plans and shaking confidence in the very process of investing. The challenge is not a lack of information, but an inability to correctly interpret it outside the context of what is familiar. The reason our projections so often fail is that cycles are not linear. They are not predictable, repeating patterns like the phases of the moon. They are adaptive. An economic cycle is a complex adaptive system, more like a biological ecosystem than a mechanical clock. Each participant, every consumer, every company, every investor reacts to the conditions of the cycle, and their collective actions, in turn, change the nature of the cycle itself. When growth is strong, businesses invest more, which fuels more growth. When fear takes hold, consumers save more, which can dampen economic activity. This constant feedback loop means the system is always evolving. The rules of the game are subtly changing with every move. This adaptive nature is why the most important shifts are often the quietest. When productivity improves quietly, it often goes unnoticed. A software update that saves each worker 5 minutes a day doesn't make headlines. A new logistical process that shaves 10% off shipping times is invisible to the end consumer. Yet, compounded across an entire economy, these small, quiet gains are the very essence of long-term growth and rising living standards. They accumulate silently beneath the surface, building a powerful foundation for future prosperity. When efficiency improves incrementally, it feels insignificant. A factory that reduces its energy consumption by 1% this year and another 1% the next seems to be making trivial progress. But over a decade, these incremental gains compound into a massive competitive advantage and a significant reduction in resource use. We are psychologically wired to notice sudden dramatic events, but we consistently undervalue the power of slow, steady, compounding progress. It is the tortoise, not the hare, that truly drives economic advancement over the long run. And when capital allocation becomes smarter, it looks boring. The dramatic stories are about speculative ventures and high-flying IPOs. But the real work of building a resilient economy happens in quieter decisions. It's a company choosing to pay down debt instead of pursuing a risky acquisition. It's a management team reinvesting profits into high-return internal projects rather than stock buybacks at an inflated price. These decisions don't generate exciting headlines. They are the slow, deliberate, and often unglamorous work of prudent stewardship. Yet this intelligent allocation of capital is the lifeblood of a healthy economy. It ensures that resources flow to their most productive uses, preventing the formation of bubbles and laying the groundwork for sustainable, durable growth that can withstand the inevitable shocks and downturns. Recognizing these quiet forces is the first step toward navigating the complexities of the long cycle. But over time, these forces accumulate. And when they do, the economy's capacity expands. This expansion does not eliminate downturns. It changes how downturns behave. Recessions in high-productivity environments tend to be shorter. Recoveries tend to be faster. Balance sheets tend to be stronger. This is why long-term investors care about structure, not sentiment. Sentiment changes quickly. Structure changes slowly. And slow changes are the ones that matter most. Another important aspect of long-term cycles is memory. Markets remember pain. Investors remember losses. Systems remember stress. This memory influences behavior long after conditions improve. Capital becomes cautious. Risk tolerance declines. Expectations remain low. This is why transitions often begin quietly. Confidence lags reality. The economy can improve while people remain skeptical. Productivity can rise while fear persists. This disconnect is where opportunity lives, because markets price expectations, not just data. When expectations are anchored to old constraints, assets are often mispriced relative to new realities. This does not mean prices immediately rise. It means pressure builds slowly. Long-term cycles do not reward impatience. They reward alignment. Alignment with productivity. Alignment with efficiency. Alignment with time. This is why some of the strongest periods of wealth creation have occurred during times of widespread doubt. Not because people were optimistic, but because they were wrong about limits. As cycles evolve, narratives follow, slowly. What once seemed impossible becomes normal. What once felt risky becomes routine. What once felt fragile becomes durable. But by the time consensus shifts, much of the opportunity has already passed. This is why long-term thinking feels lonely. It requires sitting with uncertainty. It requires resisting urgency. It requires trusting structure over emotion. And structure does not shout. It whispers. Understanding long-term cycles is not about predicting dates. It is about recognizing phases. Are we in a phase of expansion, or consolidation, or reconfiguration? Each phase demands different behavior. Periods of reconfiguration often feel stagnant, but they are foundational. They prepare the system for the next phase of growth. This is where we are often misled by surface-level indicators. Growth may look slow. Markets may look range-bound. Confidence may feel low. But beneath that surface, systems may be becoming more capable, more efficient, more adaptable, more resilient. These improvements rarely show up cleanly in headlines. They show up in how the system responds to stress. Does it break or does it bend? Bending is a sign of strength. This is why potential growth matters so much. It defines how much bending the system can tolerate before it breaks. When potential growth rises, the system can absorb more activity, more demand, more investment, without destabilizing. That does not eliminate cycles. It makes them less destructive. And less destructive cycles are incredibly valuable for capital, because they allow compounding to continue. Long-term cycles are not about avoiding downturns. They are about surviving them intact. This is the difference between short-term survival and long-term success. Investors who understand this do not fear volatility. They fear fragility. And fragility is reduced by productivity, efficiency, and adaptability. These forces are slow, but they are powerful. And they are shaping the next phase of the cycle right now, quietly. Capital behaves differently depending on how it understands the environment. When the environment feels fragile, capital becomes defensive, short-term, reactive. When the environment feels resilient, capital becomes patient, deliberate, strategic. Smart capital is not defined by size. It is defined by behavior. It does not chase clarity. It studies structure. In periods where potential growth is rising quietly, smart capital avoids extremes. It does not assume perfection, but it also does not assume collapse. Instead, it asks better questions. Can productivity continue improving? Can efficiency absorb volatility? Can systems adapt without breaking? These questions shape decisions far more than headlines. Smart capital understands that the biggest risk is not volatility. It is misalignment. Misalignment between time horizon and asset. Misalignment between expectations and structure. Misalignment between fear and reality. In these environments, smart capital extends its horizon. It accepts that returns may be uneven, that progress may feel slow, that narratives may lag reality. But it also understands that compounding requires time. This is why smart capital prioritizes resilience, strong balance sheets, durable business models, adaptable systems. Not because these are exciting, but because they survive cycles. Survival is underrated. The most successful capital does not win every year. It wins over decades. And winning over decades requires discipline. Smart capital also avoids overreaction. It does not assume every slowdown is failure. It does not assume every rally is permanent. It understands that cycles breathe. Expansion and contraction are natural. What matters is direction over time. In the calculus of long-term value creation, certain principles remain constant, even as the variables of the market shift and swirl. Among the most foundational of these is the pursuit of quality. This is why smart capital, in its most disciplined form, focuses on quality not as a preference, but as a prerequisite. It is an anchor in the uncertain seas of economic cycles. Quality is not a mere label applied to a balance sheet. It is a structural attribute, a measure of intrinsic resilience that determines how an asset or an enterprise will behave under stress. It is the difference between a structure that can withstand a storm and one that is merely designed for fair weather. While other forms of capital may chase fleeting narratives or momentum, smart capital seeks out the enduring characteristics that allow for compounding over decades, not just quarters. It understands that the highest returns are often not the product of the greatest risks, but of the most durable advantages. This focus is a deliberate act of analytical rigor, a commitment to seeing the world as it is, rather than as one hopes it might be. This pursuit begins with a forensic examination of the numbers. The first pillar is the quality of earnings. Smart capital interrogates the income statement, looking beyond the headline number to understand its composition. Are these earnings derived from sustainable recurring operations, Or are they inflated by one-time gains, accounting adjustments, or aggressive revenue recognition? It seeks earnings backed by tangible cash. This leads directly to the second pillar, the quality of cash flows. Cash is the unambiguous lifeblood of any enterprise. High-quality cash flows are consistent, predictable, and ideally growing. They represent the real economic profit that a business generates, the surplus that can be reinvested for growth, returned to shareholders, or used to strengthen the balance sheet. Smart capital scrutinizes the cash conversion cycle, understanding that a business that cannot efficiently turn its revenues into cash is building on a foundation of sand. It distinguishes between companies that generate cash and those that consume it, recognizing that the latter are often far more fragile than their income statements might suggest. But quality extends far beyond financial statements. It is deeply embedded in the human systems that govern an enterprise. This is the quality of governance. Is the board independent and aligned with long-term shareholders? Is there a culture of transparency and accountability? Smart capital looks for governance structures that act as a check on managerial overreach and short-termism. It favors boards that ask hard questions and management teams that provide straight answers. Closely related is the quality of incentives. How is the leadership team compensated? Are their rewards tied to metrics that create genuine, sustainable value, like return on invested capital and free cash flow per share? Or are they incentivized to pursue revenue growth at any cost, or to manipulate earnings to hit quarterly targets? Misaligned incentives are a leading indicator of future value destruction. Smart capital understands that incentives drive behavior, and behavior over the long run determines outcomes. These qualities of earnings, of cash flows, of governance, and of incentives are not academic. They are the determinants of survival and success, and these qualities matter most when environments are changing. In periods of stability and abundant liquidity, mediocrity can be disguised as competence. Poor business models can be sustained by cheap debt, and weak governance can be overlooked amidst rising asset prices. But when the tide of capital recedes, when economic conditions become uncertain or hostile, it is the underlying quality of an enterprise that is revealed. The robust survive, the fragile break. In unstable environments, leverage looks attractive as a tool to amplify returns. But in stable environments, its true nature is exposed. Leverage is a double-edged sword, a powerful amplifier of both gains and losses. It introduces fragility into a system by creating a non-negotiable claim on future cash flows. When times are good and asset values are rising, leverage appears to be a brilliant stroke, magnifying returns on equity. But it fundamentally alters the character of an investment, making it brittle. A small decline in the value of an underlying asset can be magnified by leverage into a catastrophic loss of equity. The margin for error shrinks to zero. Smart capital understands that the price of using leverage is a loss of flexibility and an increase in fragility. Smart capital respects this difference. It views leverage not as a default tool for enhancing returns, but as a specific risk to be consciously underwritten or avoided. It prioritizes a fortress balance sheet, one with low debt, ample cash, and flexible covenants. This is not a sign of conservatism for its own sake. It is a strategic choice. A strong balance sheet is a source of immense strategic advantage. It allows a company to weather downturns not just by surviving, but by being able to act opportunistically when others are forced into retreat. It can invest in its business, acquire distressed assets, and gain market share precisely when its competitors are constrained. This capacity for action during periods of stress is a form of optionality, a valuable asset in itself. It does not build fragile positions on optimistic assumptions. Instead, it builds robust portfolios designed to perform across a wide range of possible futures. This is the essence of robustness, The ability to absorb shocks and adapt to unforeseen circumstances without suffering catastrophic failure. It is achieved by layering sources of quality, maintaining a strong capital position, and, crucially, by embracing optionality. Optionality is the right, but not the obligation, to take a future action. It is the value of having choices. A cash-rich balance sheet provides the option to acquire a competitor. A flexible supply chain provides the option to pivot production. A portfolio of uncorrelated assets provides the option to rebalance in a crisis. Smart capital actively seeks to build and preserve optionality, understanding that in a complex and unpredictable world, the ability to adapt is the ultimate competitive advantage. It pays a premium for flexibility, knowing that the future is a distribution of possibilities, not a single predictable point. This combination of quality, prudent leverage, robustness, and embedded optionality is the signature of capital that endures. The architecture of intelligent investment is not designed for a world of perpetual calm. It is engineered for reality, a reality that includes storms, shocks, and seasons of profound disappointment. The foundational principle is the construction of robust positions, portfolios, and strategies structured not merely to survive adversity, but to endure it with their core integrity intact. A robust position is like a seawall. It does not pretend the ocean is not powerful. It anticipates the full force of the tide and is built with that force in mind, absorbing and redirecting energy rather than attempting to meet it with brittle resistance. This quality of robustness is what allows an investor to withstand the psychological and financial pressures of a downturn. It provides the stability needed to act rationally when the prevailing mood is one of panic, to see opportunity where others see only ruin. It is the bedrock upon which a long-term philosophy can be built, a quiet confidence that the structure will hold even when the waters rise. This is not about rigidity. A truly robust system possesses flexibility. It can bend without breaking, adapting to stress in a way that a fragile, unyielding structure cannot. It is the difference between an oak tree, which sways in a gale, and a glass pane, which shatters at the first impact. Building this resilience, however, is often misunderstood. It is not a retreat from the world of risk. In fact, attempting to avoid all risk is one of the most certain paths to failure. Holding only cash carries the risk of inflation and opportunity cost. Refusing to innovate carries the risk of obsolescence. The goal is not the elimination of risk, but its careful and deliberate selection. This does not mean avoiding risk. It means choosing risk intentionally. Intentional risk-taking is an act of precision. It means identifying which risks are worth taking, those that offer a commensurate reward for the potential downside, and which are not. It is the practice of underwriting uncertainty. Before committing capital, the intelligent investor asks, what is the nature of this risk? Is it a temporary fluctuation or a permanent impairment? What is the maximum conceivable loss, and can my broader position withstand it? What are the hidden assumptions in this thesis? This process transforms risk from a vague and menacing fog into a known and measured variable. It is the difference between wandering into a wilderness without a map and embarking on a calculated expedition with the right equipment, a clear destination, and an understanding of the terrain. Unintentional risk, by contrast, is the silent threat. It lurks in unseen correlations, in the second-order effects of a decision, and in the unexamined belief that the future will resemble the past. Smart capital actively seeks to minimize these unknown unknowns, focusing its exposure on risks that are understood, priced, and embraced for a strategic purpose. Smart capital understands that risk is unavoidable, but fragility is optional. This is the critical distinction. Fragility is the condition of being vulnerable to volatility and shocks. A fragile position is one that can be broken by a sudden market swing, a change in interest rates, or a shift in sentiment. It is often the result of excessive leverage, a lack of liquidity, or a dangerous concentration in a single outcome. It creates a situation where the investor is no longer in control, forced to react to events rather than executing a plan. The antidote to fragility is not the absence of risk, but the presence of optionality and resilience. It is about structuring one's affairs to have the power to respond, rather than the obligation to react. This means maintaining reserves, having multiple paths to success, and ensuring that no single event can cause catastrophic failure. It is the recognition that while we cannot control the world, we can control our own exposure to it. We can choose to build a vessel that is seaworthy, capable of navigating both calm seas and violent storms. The market will always generate waves of uncertainty. The question is whether you are in a fragile raft or a well-provisioned ship. The ship still feels the motion of the ocean, but it is not threatened by it. It has a rudder, a destination, and the structural integrity to complete its journey. This is where many investors go wrong. They fundamentally misinterpret the nature of danger in financial markets. They confuse volatility with danger. They confuse movement with risk. They watch the daily, hourly, and even minute-by-minute oscillations of an asset's price and equate that noise with genuine peril. A stock that moves up and down 5% in a week is seen as risky, while an asset that barely moves is seen as safe. But this is a profound error in judgment. Volatility is merely the measure of price fluctuation over time. It is movement, not necessarily a measure of the probability of permanent loss. In many cases, volatility is the very source of opportunity. It is the mechanism by which assets become mispriced, allowing the discerning investor to buy low and sell high. A market without movement is a market without opportunity. The real risk is not that an asset's price will fluctuate. The real risk is that its underlying value will be permanently impaired. A company whose business model is disrupted, a bond issuer that defaults, a property that becomes stranded, these are instances of true risk, the kind that leads to irreversible capital loss. This danger often arrives not with a bang, but with a quiet, steady erosion of fundamentals that the market ignores until it is too late. Focusing on volatility is like watching the whitecaps on the ocean's surface while ignoring the powerful undertow below. The fear of volatility leads to a second, more critical error: the failure to understand where the true danger lies. The real danger is not a market decline. The real danger is being forced to act at the wrong time. It is the forced sale, the margin call, the liquidity crisis that transforms a temporary, paper loss into a permanent, realized one. When an investor is forced to sell a sound asset during a panic simply to meet a financial obligation, they are crystallizing a loss at the moment of maximum pessimism. They are selling what is valuable to others who have the capacity to buy. This is the essence of fragility. The investor who has over-leveraged their position, who has no cash reserves, or whose time horizon is too short, has surrendered their agency. They are no longer a participant in the market, they are a victim of it. Their decisions are dictated not by their long-term thesis, but by the short-term demands of a creditor or the panicked impulse to stop the pain. Smart capital, therefore, obsesses over this single factor, preserving the power to act or not act according to its own judgment and time frame. It structures its finances to ensure it can survive any storm without having to abandon ship. It understands that time is the ultimate ally of the well-prepared investor and the ultimate enemy of the fragile one. The greatest risk of all is the loss of control over one's own decisions. In the architecture of enduring capital, certain principles are non-negotiable. They are the load-bearing walls of a portfolio designed not merely to survive, but to evolve and strengthen through the cycles of market time. These are the tools for adaptability, the instruments that separate transient success from structural resilience. At the forefront of this toolkit are three interdependent virtues: liquidity matters, flexibility matters, optionality matters. These are not abstract concepts. They are tangible assets, as critical as any security held. Liquidity is more than just the presence of cash. It is the state of readiness. It represents the potential energy of the portfolio, the capacity to act decisively when opportunities arise or when defensive maneuvers are required. Without it, an allocator is a spectator, forced to watch events unfold rather than participate in shaping outcomes. It is the freedom from being a forced seller in times of stress, and the power to become a strategic buyer when others are constrained. It is the oxygen that allows a long-term thesis to breathe through periods of market suffocation. Flexibility, in turn, is the structural capacity to change course. It is the governance and the mindset that allow a strategy to pivot, not out of panic, but in accordance with new information. A rigid mandate, no matter how well conceived for a specific environment, becomes a cage when that environment transforms. True flexibility is built into the foundation of an investment charter. It is the understanding that the map is not the territory, and that the ability to redraw the map is a paramount strategic advantage. It is the institutional humility to acknowledge that the future is not a straight-line extrapolation of the past, and the preparedness to navigate its inevitable detours. Finally, optionality is the art of acquiring choices. It is the deliberate positioning of capital to create future pathways, often at a low initial cost. It is about paying a small known price today for the right, but not the obligation, to make a significant decision tomorrow, when the fog of uncertainty has lifted. Each option held is a key to a door that may or may not need to be opened, a strategic reserve of potential actions that allows an allocator to benefit from volatility rather than fear it. When combined, these attributes allow capital to respond, not react. This distinction is fundamental. A reaction is a visceral, often emotional, reflex to immediate stimuli, a sudden market drop, a surprising headline, the clamor of the crowd. It is driven by the amygdala, the primitive core of the financial brain. It is the instinct that compels the herd to stampede, often over a cliff. A response, by contrast, is a considered, deliberate action filtered through a pre-established framework. It is analytical. It is rooted in a long-term thesis and guided by a clear understanding of objectives and risk parameters. It is the execution of a plan that has already contemplated the possibility of the current event. While others are caught in the frantic cycle of fear and greed, the responsive allocator is calmly consulting their checklist, assessing the deviation from their baseline, and executing a predetermined protocol. Liquidity provides the time to think, flexibility provides the ability to act, and optionality provides the menu of effective choices. Smart capital also understands that transitions are uneven. The great shifts in technology, regulation, and consumer behavior do not unfold like a smooth, uniform wave. They move more like a complex weather front, with pockets of intense activity, areas of calm, and unpredictable cross-currents. The adoption of a new energy source, the digitization of an industry, or a change in global trade dynamics never happens all at once. The process is messy, fragmented, and asynchronous. Some sectors adapt faster than others. A technology company might integrate a new software paradigm in months, while a heavy industrial manufacturer might take a decade to retool its factories and supply chains. The regulatory environment in one jurisdiction may accelerate a transition, while in another, it may create insurmountable barriers. Some businesses capture efficiency gains sooner. Within the same industry, two firms can face the same external shift with vastly different outcomes. One, with a nimble management team and a culture of innovation, quickly reallocates resources, retrains its workforce, and captures the benefits of the new reality. Its competitor, burdened by legacy systems, bureaucratic inertia, or a failure of vision, struggles to keep pace. As this process unfolds, some models become obsolete. The very logic that made a business successful for generations can become its undoing. The vertically integrated behemoth is challenged by the networked specialist. The brick-and-mortar retailer is displaced by the e-commerce platform. The business model predicated on information asymmetry is dismantled by the transparency of the internet. This is the relentless churn of creative destruction, and it does not proceed in an orderly fashion. It is a staggered collapse, where value is simultaneously destroyed in one area and created in another. This creates dispersion. Dispersion is the statistical signature of change. It is the widening gap between the winners and the losers. In a stable, predictable environment, the performance of most assets within a class tends to cluster around the average. Returns are compressed. But during a period of transition, the distribution of outcomes widens dramatically. The best performers post extraordinary returns, while the worst performers may face existential failure. The bell curve flattens and spreads, its tails growing longer and fatter. And dispersion creates opportunity. For the passive investor who simply owns the entire market, dispersion is a neutral force. The gains of the winners are offset by the losses of the laggards. But for the active, discerning allocator, dispersion is the fertile ground where alpha is grown. It is the very phenomenon that makes security selection and active management valuable. The opportunity lies in correctly identifying the future winners and avoiding the future losers, or even actively betting against them. It is the chance to acquire tomorrow's leaders at yesterday's prices, while sidestepping the value traps that litter the landscape of change. The greater the dispersion, the greater the potential reward for correct judgment. It transforms the investment landscape from a placid lake, where all boats rise and fall with the tide, into a dynamic river system with powerful currents and eddies, where skillful navigation can lead to a much faster journey. But only for capital that is patient enough to identify it. The opportunities created by dispersion are rarely obvious in the moment. They are obscured by noise, uncertainty, and the prevailing narratives of the day. Identifying them requires deep, fundamental research, a skeptical mindset, and, above all, a willingness to operate on a different timescale from the broader market. Patience is not passive waiting. It is an active, disciplined process of observation, analysis, and preparation. It is the patience to conduct thorough due diligence while others are chasing momentum. It is the patience to hold a position that is temporarily out of favor, confident in the long-term thesis. It is the patience to let a winning investment compound over years rather than succumbing to the temptation to take a quick profit. It is the quiet confidence that allows one to stand apart from the crowd, knowing that the value of an asset and its market price can diverge for long periods, but that they will ultimately converge. This is why short-term traders struggle in these environments. Their entire model is predicated on predicting immediate price movements, a task made nearly impossible by the chaotic nature of deep transitions. They are whipsawed by volatility, reacting to every headline and rumor. Their time horizon is too compressed to distinguish the signal of structural change from the noise of daily market fluctuations. They are playing a different game, one that is ill-suited to the dynamics of dispersion. Long-term allocators, by contrast, thrive. Their framework is designed for exactly this type of environment. They use the market's short-term focus to their advantage, acquiring assets from impatient sellers at attractive valuations. They see volatility not as a threat, but as the source of mispricing and opportunity. Their patience is their edge. Their extended time horizon allows them to look through the cycle, to focus on the fundamental drivers of value creation, and to position their capital to benefit from the powerful, multi-year trends that dispersion reveals. They are not forecasting, they are preparing. They are not reacting, they are responding. They are not just investing, they are allocating capital through the uneven terrain of history. Because allocators think in systems, not signals. They understand that returns come from alignment with long-term forces, not from guessing the next move. This is why smart capital often looks boring. It does not generate excitement, it does not attract attention, it does not trend. But over time, it compounds quietly, and quiet compounding is powerful. In environments where potential growth is misunderstood, smart capital benefits from skepticism. Low expectations create asymmetry. Durability becomes undervalued. Patience becomes rare. This is the setup for long-term outperformance. Not because outcomes are guaranteed, but because probabilities improve. Smart capital does not need certainty. It needs favorable odds. And favorable odds come from understanding structure. This is why the most important work is not forecasting. It is observation. Watching how systems respond. Watching how efficiency evolves. Watching how capital reallocates. These signals are subtle, but they are consistent, and consistency matters. The role of smart capital is not to predict the future. It is to remain positioned for it. Positioned to benefit from resilience. Positioned to withstand volatility. Positioned to compound over time. This is how wealth is built. Not quickly, not loudly, but steadily. And in the final analysis, the slow and steady approach wins.